Welcome, ladies and gentlemen, to the CIO Global Investment Outlook. And this is the mid-year update, where we get to do a stock take on the year so far, look at the accelerating trends, and see how that all maps to the prognostication offered up by the Emirates MBT team back in January. Basically, we're going to mark their homework. I'm Scott Armstrong. I'm the Editor-in-Chief of Arabian Business. Some would say I'm a poor man's Richard Dean, in that I have half the presentation skills, twice the weight, and a quarter of the knowledge. But like you, I'm excited to learn what's ahead for the next 6 months of 2021. Here at Arabian Business, we've been reporting on a rising tide of optimism, particularly here in the UAE, which is reflected in some parts of the Gulf, but not all. But can that last? We've had a tide of magic money through global fiscal stimulus. But what happens when the wand is no longer being waved? And there is still a pandemic out there. Has that been priced in, or is there still a sting in the tail for investors? Well, I am delighted to introduce in a moment a man with many answers, Maurice Gravier, the Chief Investment Officer of Emirates MBD. But a pro tip for our audience watching, later we have an exciting segment on cryptocurrency, the financial trend du jour. But for now, let me introduce you to the man that puts the fun into fundamentals, the walking algorithm himself, Mr. Maurice Gravier. Maurice, over to you.
Thank you, Scott, and a warm welcome to all to our mid-year outlook. My colleagues and I are delighted to share our views on the big picture, on bonds, on equities, and yes, on cryptocurrencies. Without further ado, the big picture is for me, and I will start, as always, in full transparency by comparing what we said for the year and to what happened so far. What did we say initially for 2021? We were expecting positive returns, less good than in 2020, but still positive returns. We expected volatility, and we thought that all stars were aligned for emerging markets. So what happened in the first half of the year? First, no doubt, it was a good year, and it was right to be super bullish on equities like we were. But it was not the rally of everything that we saw last year. It was differentiating. At the top, you see the asset classes that are the most sensitive to economic growth, namely stocks and global listed real estate. On the bottom, you can see that this first half, defensive assets have been punished with negative returns, should it be for gold or for high quality bonds. It's a risk-on configurations, quite different from last year. So what about our calls? Positive returns, yes, no doubt, even stronger than what we expected. Volatility, some volatility, but finally not that much. And emerging markets, well, they did well in absolute, plus 7.4% in H1, but they did not outperform developed markets. So what are we doing now? We have started from June to very gradually reduce risk and exposure in our portfolios. We switch from super bullish to constructive, and I'll tell you why. And to tell you why, I have to go through the three key market drivers that are the basics of all our investment decisions: the backdrop, valuations, and sentiment. We'll go in details into that, but let me start to tell you that the backdrop, the economic growth, is the strongest we have seen in decades. It's enabled by the vaccines, it's kick-started by fiscal stimulus, and it's turbocharged by monetary stimulus, the two together being the magic money. I told you it's even stronger than what we expect due to the Biden administration being really all in on magic money. As a result, growth is strong, but inflation is back, and it raises questions on the future trajectory of stimulus. Valuations, they were expensive. Of course, they still are expensive because markets are up and sentiment is a bit worrying. Let me go into some details. Let's start with the virus. There are two different situations between developed regions and emerging regions. In the first one, new cases, the orange line, are falling and activity is rising as expressed by mobility. But in emerging regions, new cases are struggling because of the new variants and less vaccinations, and as a result, mobility hasn't reached the pre-pandemic levels yet. The key question, the Delta variant is currently taking over the world and cases are rising again in developed economies. So should it derail the global growth? We don't think so. And the reason is that hospitalization rates are going down. What matters for the economy is the restrictions, and governments put restrictions when hospitals are saturated. This is not the case. Let me take an example. Israel, second most vaccinated country in the world after the UAE. 1 month ago, we had 15 new cases per day. Not much. Now it's closer to 500. How many people are in hospital? Less than 50. So what we believe is that we move from a pandemic to endemic. We will learn to live with the virus and it will not derail global growth. Second item in our backdrop analysis, what about the magic money? Numbers are huge by comparison. You can see on the left the total money creation by central banks, and on the right, total response by country as a percentage of GDP. That's simply uncharted territory. By comparison, the response to the great financial crisis were a picnic. So, of course, the key question is, will it fade looking forward? Of course it will, but very gradually. Let's start with the US. The US Fed is forecasting a 7% economic growth, extremely strong, and they see inflation coming back. Having said that, what are they doing? They are just started to talk about reducing their current pace of 120 billion US dollar being created every month. It's going to be very gradual. In Europe, the European Central Bank has just adopted a more permissive inflation target. Even in China, the most orthodox country, they just reduced the reserve required ratio to inject more liquidity in the system to face their current slowdown. So our take is that, yes, of course, you cannot live with this level of fiscal and monetary stimulus, but it's going to be very gradual to remove it. Magic money is here for long. So what does it mean for economic growth? What you can see on this chart is the IMF projection, and it's good to keep in mind that the world this year will exceed the pre-pandemic level. Look, 2020 was a minus 3.3% shock. 2021 should be a 6% growth. So our take is that the virus will not derail the global growth, that magic money removal will be very gradual, and don't forget, the global economy is not firing on all cylinders right now. First, regionally, there is a sequence. The US leads, no doubt they are stabilizing, but the rest of the world is catching up. And it's the same in terms of sectors. After manufacturing, services have only started to accelerate. Think hospitality, travel, tourism, and this is huge. This is why we are very confident on the backdrop. Backdrop is not everything. Let's look at valuations. And before talking about equity valuations, it's interesting to have a look at interest rates. On the chart on the left, the blue line is the US 10-year government bond yield. Quite low. The orange line is a measure of inflation. Look at that. The level of inflation is higher than at any point in the last 20 years. But interest rates are not much higher than they were in the previous 20 years. What does it mean? It means that if you invest today in a 10-year US bond and you get 1.4%, and if you correct this from inflation, if you guess that inflation will stay where it is, you have a negative real return. And this is the chart on the right. This is very wrong, despite being on the right. Either inflation has to come down or interest rates have to go higher. We believe a bit of two, but it means that to us, without any doubt, interest rates are too low, which means that bond valuation is too high. And it matters. It matters for equities. These are equity valuations. On the left side, you look at the multiples. Developed markets in blue, emerging markets in orange. Yes, they are very high from historical perspective. They are at all-time highs. But if you look on the right and you compare the remarkable stability of dividend yields to the real interest rates that I just showed you, you say that, my God, equities are a bargain. You may say it's a bit unfair to deduce inflation from government bond yields and not to dividend yields. And it's debatable, but don't forget that equities will reflect inflation, turnover, earnings. When prices rises, they rise as well. Equities are nominal assets. So we think it makes sense to compare. And bottom line, what it means is that equity valuations are even more expensive in absolute than they were 6 months ago, but compared to real interest rates, they are even cheaper. So the backdrop is good. Valuations are to be watched. What about behavioral factors? Behavioral factors are worrying. Why? Because sentiment is extremely high. Investors are unanimously optimistic. As you can see, it's not just a matter of sentiment and positioning, it's also IPOs that are at record high levels, including investment in SPACs, which are basically blank check companies. I'm not even talking about meme stocks where retail investors gather on internet forum to attack hedge funds short position, or not even talking about the market cap of cryptocurrencies, which exceeds those of very, very big global companies. So behavioral factors are very hot. Sentiment is too positive to be a support looking forward. It's the absolute opposite situation than last year. Last year, everyone was terrified. It was easy to buy any dip because the market was not ready for good news. Now it's different. Is it outright bearish? No, it just means that you have vulnerability looking forward. So if we put all that together, we have a strong backdrop. We have valuations to be watched and we have concerns on behavioral factors. So how does this combine to do our messages for the second half? Backdrop wins. We are fundamental investors and we think that strong economic growth is stronger than the rest. So our central scenario is to expect an additional 2 to 4% return to our three profiles for the second half of the year. Second message is still volatility and more than ever. Why volatility? Of course, there is no shortage of catalysts to be worried and it would meet elevated valuation and optimist positioning. Another COVID wave, we told you we are confident on that. Policy support, we are confident on the fact that it's going to be gradual enough. Inflation, we think it's transitory, but the markets will be able to worry. Volatility means that our own confidence in our own central scenario is not what it used to be. At the beginning of the year, we were super bullish. We were 80% sure that our scenario was right. It was not wrong, I must say. Now we would put a 60% probability on the central scenario of having an additional 2 to 4% positive return for the end of the year. 10% probability, we are way too conservative. Growth is strong. Markets will rally more. What will happen if it's the case? If we go to the sky in valuation, of course, our three profiles will be up, but we will be lagging our competition because we are not as aggressive as many others. 60 plus 10, we are missing 30% probability. We put this 30% on the scenario of a significant, severe market correction, which could happen during the summer. 30% is low enough not to be a central scenario, but it's high enough to be taken into consideration. And to that extent, let me be very clear. Should it happen, everything else being equal, we would see that as a buying opportunity. So this is why in our current positioning, we own cash. It's significant. 15%, 10%, and 5% in our profiles is in cash to be able to seize the opportunities. For the rest, we are underweight fixed income because we think interest rates are too low, so especially the most defensive segments. We are overweight equities. My colleagues will give you all the details. And we are, which is the most important, ready to adapt, especially our ideal sequence would be to see some turbulence, to have opportunity to put our cash at work. And now, as a conclusion, and as always, in full transparency, we end with our performance compared to our global competition. You know that our aim for our three profiles is to be better than competitors when markets are difficult and to try to be not too distant when markets rally. In the difficult 2018, we were much better. In the very positive 2019, we were slightly below. Last year, we had our best year ever because we were defensive during the crash in the first part of the year and we were fully invested after. That's why we strongly outperformed competition. This first half of the year, yes, our three profiles are positive by, in round numbers, 2%, 4%, and 6.5%, but we are lagging competition. And there is a reason for that. The reason is that, as you know, we embed capital preservation in our allocation. You won't lose money on 3 years, 5 years, 7 years with our profiles. Our competitors don't, so they have more risk assets than we have. And you remember, this year is about risk on configuration where risk assets are positive, defensive assets are negative. However, we are very confident that our allocations are right. And with that, Over to you, Scott.
Thank you, Maurice. I love that we've basically just downloaded Maurice's brain into that presentation. I hope you got all that. If you struggle to keep up, I recommend you go into your YouTube settings and hit 0.75 playback, and you should be golden. Next up, it's Anita Gupta, Emirates NBD's Head of Equity Strategy. She has more than 25 years worth of investing experience, which means she must have started when she was 10 years old. But basically, this is your opportunity to get granular on what's in store for the markets ahead. I hear that she's phenomenally good at overweighting, something I can very much relate to. Anita, I can almost hear the audience leaning into the screen, so it's over to you.
Hello everybody. Equity positioning after a period of extraordinary returns is challenging. Post the pandemic-driven sell-off in March last year, we have seen global equities go up 93%, just a little less than the 100% returns of the last decade. Favorable monetary policy, huge fiscal stimulus, a resurgence of consumer demand, and of course, the rebound in corporate profits is supportive of the returns that we are seeing today in equity markets. Leadership, however, has moved from the COVID winners in the digital space to the cyclical winners, the recovery trades. If you look at the chart in front of you, the blue line depicts the MSCI World Growth Index and the orange line is the MSCI World Value Index. Growth has led the last 3 years. However, in November, we saw treasury yields surge, and that led to value for the first time in the last few years, making a rebound and outperforming. In June this year, however, we saw the treasury yield curve flattening and inflation fears subsided, and growth stocks such as technology, which had been decade-long winners and had been underperforming, are back once again. When we wonder whether we should be in growth or value, we say stay agnostic. Focus on quality at a reasonable price. Today, every company is a technology company. Every company is focused on ESG, and that's where we would be headed. Look at the demand trends. When we see the performance of the first half of this year, we look at the regions, and developed markets have outperformed, followed the vaccine drive. The US and European indices have made new records. We have also seen outperformance from the UK, which is a commodity-driven economy. Emerging markets have lagged as China is a big weight. And of course, the regulatory scrutiny of tech companies in China, along with credit controls, has led to that underperformance. India performance is in line with global markets. The outperformer has been the UAE. The Abu Dhabi index is up 41% and the Dubai index 16% in the first half of this year. On the sector front, we have, of course, seen the cyclical sectors, energy and financials outperform. We look at our market health checklist, and that's what determines what's going to be happening for the rest of this year and into the foreseeable future. The most important factor has always been earnings growth, which is 85 to 90% correlated with equity performance. We have had a stellar quarter one in terms of earnings, and expectations are for a record quarter two. And that's what convinces us that we are going to continue to see positive returns from equities in the second half of this year, though of course muted and much less than what we saw in the first half. Stimulus, liquidity are supportive, record inflows into equities, $580 billion in the first half, which on an annualized basis is more than the $800 billion we've seen over the last 20 years. Yields at the moment are what we call in a safe zone. We see inflation fears as being transitionary. We also see that central bank tightening is some time away. So what should we worry about? Definitely commodity prices rising, as well as wage growth. We're also seeing supply chain constraints. However, this is mitigated by profit margins being at records. We now wonder, when are we going to see the next 5 to 10% drop? How should we be positioned? Our positioning is we are overweight equities with a bias towards developed markets. As Maurice spoke about the vaccine rollout, follow the vaccine rollout in terms of positioning. Today, in developed markets, the US remains our long-term overweight as we think it is the bed of all innovation. However, on a tactical basis, we like Europe. Emerging markets, which have always had a growth premium, today have a lower growth compared to where developed markets are, and that's because of the pandemic effect still being seen there. However, longer term, we think that the consumption, the large middle class, digital revolution would bring back that growth premium. In sectors and themes, we think that the rotation between cyclical and value is going to continue. As a cyclical play, we like financials. For growth, we like technology and healthcare. And for income-seeking investors, many commodity and energy companies give you a dividend of over 3%. Of course, all this is overlaid by ESG. And remember, selectivity pays. Investing in quality companies with strong balance sheets and sustainable businesses always outperforms. Looking at the fair value estimates for the equity indices for the 8 major geographies that we cover, we expect substantial upside into year-end based on these fair values. The fair values are just based on a very simplistic price to earnings and an EPS multiple, which of course is driven by EPS growth. Price to earning multiples, as estimated by us, are going to be lower than where they were at the end of last year. EPS growth, however, is going to be higher. For the GCC, we expect the maximum upside of all the geographies that we cover at 32%. For the US, the S&P 500, the fair value is estimated by us to be at 4,400, and we are almost there. For most of the indices, we are at the fair values, barring the emerging markets, which have been lagging in terms of performance. Our first tactical overweight, which I'm going to talk about, is Europe. And why do we like Europe? Europe, of course, on relative valuations is cheaper. It's got very high earnings growth, 45% for the Eurozone, 50% for the UK. And that still leaves some upside, around 7% into year end. Europe is also the leader in ESG adoption, whether it is the automobile companies with the shift to electric vehicle, Volkswagen, Daimler, BMW. Europe is also more cyclically aligned to what's happening globally. 60% of revenue of the Eurostock 600 companies comes from overseas. In the case of the German DAX and the European CAC, it's actually 80%. And this also makes those companies less sensitive to domestic interest rate hikes. Many companies in Europe are already on the ESG bandwagon, whether it is Nestle, Danone, the food makers, adopting sustainable packaging, shifting to plant-based, alternatives for food, plant-based alternatives to milk. Our second tactical call is our own geography, the UAE. We began talking about this in November last year, and we still think it's still very attractive valuations, especially for the Dubai market, many catalysts in play. The recent upsurgence in IPOs, of course, is lending to the market breadth. In terms of our overweights and underweights, we continue to like banking. Dividends have been maintained. Of course, higher yields are supportive of net interest margins. More recently, we have found real estate to be very attractive. Dubai is a very, very interesting place to live in terms of what we get in terms of entertainment, in the facilities, and also the recent relaxation on visa policy has encouraged many expats and end user demand on property. Projects are now being sold within an hour, something what used to happen only a few years ago. Our next theme is around connectivity, health, and environment. So while we will be positioned geographically as per the asset allocation template, we also say add alpha through themes. If you look at the chart in front of you, the blue bars are the 2020 returns and the orange bars the first half. And in most cases, select themes outperform global equities. Our 3 themes are around connectivity in the technology sector, which of course brings us to concerns around privacy and data, preventative healthcare and the synergy between healthcare and technology, and an ESG overlay with more investors, companies, and governments worried about ESG. On the technology sector, after seeing a 500% return over the last decade, do we expect anything further? Yes, definitely. The next decade is going to see more change in our health, in the industry, in everything that is around us than we have seen in the last 100 years, driven by technology and connectivity, the use of data. And that, of course, means that 5G is instrumental in the connectivity. Are we in bubble territory? No, not anymore on electric vehicle stocks. Many of them are down 25 to 50% from their peak. Semiconductor and, of course, the FANGs. Now, the FANG story is not over. You have digital advertising, e-commerce, cloud very much in dominance. Many of the FANG companies, Amazon, Microsoft, have revenue and earnings growth of over 20% for the next 5 years. Digital advertising is forecast to go up by 14% in 2021, driven by an exuberant summer of sports and other consumer events. Of course, healthcare, important, a defensive industry, and whether it is preventative healthcare, a global physical activity is now a $1 trillion industry, and the wearables that we have, the biometric monitoring in the UE and the KSA, we have seen an increase in diabetic monitoring, especially with the pandemic and the need for social distancing. Research spent is not only the big pharma companies, whether it is Roche or Pfizer, it is on genomics. The new technologies, messenger RNA, gene editing have ensured we get vaccines faster and other therapies. Within ESG, the game changer that we see this decade is the adoption of electric vehicles. Not only are governments increasing focus, the UAE today has 300 charging stations in Dubai, which are free to use for electric vehicle users. We are seeing a proliferation of electric vehicles, whether in the US, Europe, or China, as you can see in the chart in front of you. Investment ideas are not only the producers, whether it's Tesla, GM, or Volkswagen, it's also the investable universe of lithium batteries and charging stations. So to conclude, stay invested. We are going to see more volatility, but we also expect returns from equities supported by strong earnings growth and still favorable monetary policy into year end.
Thank you, Anita. And next up, it's Satya Singh, Emirates NBD's Head of Fixed Income Strategy. Now, Satya is a new team member to the CIO Avengers who debuted back in January. But I'm reliably informed in that time that he's established himself as the Hulk of the team with his aggressive stance on the bond market. So buckle up and over to you, Satya. Smash!
Thank you for the Avengers reference, Scott. Coincidentally, Hulk is my daughter's favorite Avenger. So welcome everyone to the fixed income part of the session. As customary, we'll start with how we began 2021. We asked you to get comfortable with risk. And why is that? Because we believe that the 10-year treasury yields are going to increase and only the asset classes such as high yield and emerging market debt, which have some spread headroom, they can protect your portfolio against the negative effects. We also told you to go underweight the safe haven asset classes such as investment grade credit and developed market sovereign debt. And also, trade will play a very important role to avoid any 2013 repeat of taper tantrum. But then, taperless tantrum happened. As I mentioned, it's a tale of 2 quarters thanks to Mr. Charles Dickens. As you can see on the left side of the chart, the 10-year treasury yields actually increased in quarter 1, while they retraced some of their increase in quarter 2. That means most of the asset class returns were mirror opposite, as you can see from the right side chart. So how our predictions behaved? We got 1-1 because of our underweight in developed market sovereign and IG credit. As you can see, they are the bottom of the chart. We get full points for our stance on high yield, but emerging market debt, unfortunately, because of its longer duration, did not behave as we expected. And of course, what a time we have had with Fed. So we get 3 out of 4. Not bad. But the question is, where do we go from here? Our advice is to get reasonable with risk. What does that mean? That means we believe 10-year treasury yields at current levels of 1.4%, 1.3% cannot be explained totally by fundamentals. So we expect treasury yields to rise from here onwards to the end of the year. You can maintain your underweight in global investment grade debt and developed market sovereign bonds, but you should book some profit in high yield exposure and become neutral. Emerging market debt, you can remain overweight and it will give you some alpha, while in GCC debt, we think most of the easy money is out of the picture, and going onwards, most of the carry will give you the total returns. But be reasonable with your leverage as well. Do not chase yields in a single asset class and allocate 10 to 15% of your portfolio within fixed income to safe haven asset classes. But is there a safe haven asset class which will give you higher yield while protecting your portfolio, or the holy grail of assets? We'll present you such an asset class during the course of the presentation. So, starting our deep dive in the asset class with developed market investment grade, we are still underweight, but we believe there is opportunity in financial subordinated debt. And why is that? Look at the orange line, which has some gap to the blue line, which represents the Bloomberg Barclays average yield for investment grade credit, while the orange line represents the average yield for the subordinated debt. Moreover, the US banks have passed the recently conducted Fed stress test. That means there'll be a new era of dividends and share buybacks, which will give some tailwind to this asset class. We got our overweight stance to neutral in high yield because there is a constant tussle between improving fundamentals and expensive valuations. You can see that YTD defaults are the lowest in the last 4 years. That means worst of the effect of the pandemic in 2020 is behind us. Moreover, the primary issuance in high yield has been creating new records every quarter. That means most of the small entities, they have enough cash to weather any shutdown in economies. But coming to the technicals, it's a different picture altogether. There's been 65 bips spread compression YTD in US high yields. Moreover, CPI adjusted US high yield actually gives you negative real yield. That means most of the capital appreciation from this asset class is behind us. And at negative real yield, high yield no longer gives you higher yield. Emerging market debt, we are still overweight on because they provide best relative value. Why is that? Look at the left side chart and especially look at emerging market sovereign, where the red triangle represents the current spreads and they are very close to the blue circle, which represents the historical median spreads, whereas all other asset classes are much below their historical medians in terms of spreads. Moreover, a recent research report by Fed mentions that emerging market assets are very, very resilient when treasury yields go up because of the growth in economy rather than any kind of change in the stance of monetary policy. So we believe going forward, emerging market will be a star asset class this year. But remember, emerging market can be divided into emerging market corporates and sovereigns. While the corporate exposure will give you stability, the sovereign exposure will give you higher yield. Plus, you have to remember that emerging market sovereign is a long duration asset class. So instead of going all in, you should wait for treasury dips to go into this asset class. Now remember, we talked about a holy grail of asset class. That is China onshore IG debt. This is an asset class you cannot afford to ignore. Why is that? First of all, it's the second largest fixed income asset class after the US. That means it's highly liquid. Its defaults have been historically low. And moreover, PBOC has been the only major central bank which has been prudent last year. And recently, they are starting to loosen their purse strings. That means there will be a tailwind for this asset class. Moreover, if you look at technicals, even if emerging market assets are dominated by China, but there is a very low correlation with other emerging market assets. If you look at the orange line, which represents the yield or the spread of Chinese IG debt, it behaves similar to US treasuries rather than similar to emerging market assets. And whenever there are stressful periods such as December 2018 or March 2020, this asset class actually gives you a lot of benefit in terms of that yield uptake while protecting your capitals. Moreover, this asset class, even though it's very, very defensive in nature, its yield is upwards of 5.5% for unhedged USD share classes. And for hedged share classes, you get that 3.5% kind of yield as compared to only 1 or 1.5% kind of yield in developed market IG or developed market sovereign bonds. That means this is the holy grail of assets, and we advise that you should allocate 10 to 15% of your portfolio to this asset class. Now coming to MENA debt, the total returns from here onwards should be driven by carry. While high yield has outperformed investment grade debt till now, especially driven by Oman, look at the right side chart, how the Oman spreads have come down significantly, giving you capital appreciation. But remember, Egypt between 7 to 10 years now provides you the most value in this asset class. Within investment grade MENA debt, we continue to like government related entities which give you some kind of yield uptake versus their sovereign entities. But financial subordinated debt, especially the perpetual sukuks which trade below 3.75%, do not give you enough risk premium to take any positioning. Now talking about sukuks, it's an interesting asset class. It has given you resilient performance while regulatory constraints have been increasing. We believe these regulatory constraints will actually result in a better asset class in terms of protecting the interest of sukuk holders and driving standardization in the future. But the primary issuance has not been deterred by these regulatory constraints. In fact, outside the UAE, the primary issuance this year could be create a new record. Now, YTD total distribution has been, if you look at the right side chart, driven by mostly risk-on scenario. That means most of the returns from this asset class are from the riskier parts of this segment, such as unrated or high-yield perpetual sukuks. So going forward, our advice will be to cut risk within sukuks and go up in quality. ESG, does it make sense to have a portfolio overlay with this theme in fixed income assets, especially which is focused on emerging market debt? We think so. Because not only this year will create a new primary bond issuance record, but also there is a change in the current landscape. Green bonds currently make up for 70% of this universe. But recently, we have seen 2/3 of issuance is dominated by social and sustainable bonds. Moreover, emerging market sovereigns have been quick to join the bandwagon. Especially recently, Egypt became the first issuer to issue a green bond from the MENA high yield sector. And Malaysia issued a sustainable sukuk. But does it make sense in a portfolio? We believe during risk-on periods, typically these green bonds or the sustainable bonds will require lower funding costs than their conventional counterparts. So they will give you higher capital appreciation. But during risk-off periods, emerging market investors will not benefit from any kind of asset allocation to ESG. We're happy to announce that at Emirates NBD, we are working on a framework to actually give individual ESG ratings to each and every bond that is part of our fixed income advisory and also funds. So that means you can actually understand the impact of the ESG on your portfolio and you can take correct decisions on that. So to sum up our positioning and our views, we think get reasonable with risk, get reasonable with your leverage, don't chase yields in a single asset class, be diversified, give 10 to 15% of allocation to safe haven assets, book some profit in high yield, and go into emerging market debt, especially emerging market sovereign, whenever there is a dip in treasuries. That's all from my side. Over to you, Scott. See you all in the Q&A session. Thank you.
Thank you, Satya. A powerful presentation. And now for something a little different, it's that deep dive into cryptocurrency that we promised you. It's the financial trend that you cannot escape from. Now, it's fair to say that Emirates NBD have gone on a learning curve on this alternative asset class. We won't mention Maurice's Bitcoin coffees, but I do recommend you Google the words Maurice, Bitcoin and coffee. I'm delighted though to introduce Giorgio Borelli, Emirates NBD's head of asset allocation and quantitative strategies. Basically think Neo from the Matrix, just with better kung fu. Now, with so many cheerleaders for cryptocurrency out there in the market, I'm delighted to be joined by Giorgio to take a mature look at this volatile space and to see if Elon Musk has managed to stay off Twitter for 5 minutes. Following this, we'll be back for the live Q&A, and I can promise you that the team are already limbering up for some challenging questions. But for now, Giorgio, the floor is yours.
Thank you, Scott. My presentation is focusing on cryptocurrencies, which most of you may know because of their extremely high levels of volatility and speculative appeal. My conclusion may be counterintuitive to you today, and it is that this high level of volatility will have to subside substantially for cryptocurrencies to be universally accepted in our society, for portfolio managers to accept cryptocurrencies in their portfolios, and for investors in general to be able to ascribe a fair value to them. Or what is indeed a cryptocurrency? Well, a cryptocurrency is a form of payment, and so in this respect, it is slightly the same as real money. At the same time, it's not really like real money because it doesn't exist in our physical world. It exists just in the form of an encrypted transaction carried out on a specific network called blockchain. Then you might ask, what is the blockchain? Well, think of the blockchain as a list of records shared by a large number of computing units. Well, the key feature of this network is that there is no need for an intermediary to validate and execute the transaction. Institutional participation has been increasing and of late has increased massively because of two key features of cryptocurrencies. Number one, their social utility, and number two, their increasing speculative appeal. So let's talk about that social utility and try to understand where that comes from. So here the key word is transaction. Please bear in mind that the key piece of information that the digital coin unlocks is the verification and the execution of the transaction, and this is of key importance and utility to the whole society. So it is exactly from this that digital currencies derive their value, not from the scarcity of their supply. So we come to understand a very critical concept, that the value of cryptocurrencies depends on the number of transactions. And this takes us to this slide where you can see that the cryptocurrency, Bitcoin, the orange line, swings in line with the business cycle. Why? Because the number of transactions fluctuates with the business cycle. Cryptocurrencies are tied to the number of transactions, hence cryptocurrencies fluctuate with the business cycle. This is a key concept, and then we can come to the conclusion that cryptocurrencies are indeed cyclical macro assets. For the next logical question is, insofar as they are cyclical macro asset, will they find a space in institutional investor portfolios? Our answer to this question is, as of today, no, not yet. To understand why, please focus on the squiggy blue line on the left-hand side of the slide that represent the proportion of Bitcoin return explained by some common market factor. As you can understand, the main message of that blue line is not a lot of Bitcoin risk, that's Bitcoin, can be explained consistently by market factors. Well, in a way then, if Bitcoin risk, cryptocurrency risk is unique, then, well, we could add cryptocurrencies to other risk assets like equities and credit and build a portfolio. But for that to happen, institutional investors would be demanding the expectation of a reasonably positive return, which we cannot think that expectation is met, right? Because of what is happening on the right-hand side of the slide. Please focus on the red line, which is Bitcoin volatility, sitting right at the top above the volatility of all other currencies. So the message is always one and the same. Volatility of cryptocurrencies must come down for their broader adoption within finance. Now, another legitimate question, at least when can we tell something about the cheapness or expensiveness of a cryptocurrency? Yes, we can. And so to this end, I will introduce the notion of network to value. Network to value is similar to a price to earnings, meaning that is the ratio of two variables. One market variable, in this case, the market cap of Bitcoin, and a non-market variable. In this case, the dollar value of transactions carried out on the blockchain network. And you have on the left-hand side the orange line, which is this NTV ratio, which is oscillating more or less in a band, so that when it is in the upper end of the band, you can say that Bitcoin is relatively more expensive. When it's in the lower end of the band, you can say that Bitcoin is relatively more expensive. But bear in mind that being able to time a much less volatile asset classes by means of valuations is already difficult, so it's even more difficult, this exercise with cryptocurrencies. Can we ascribe a value to cryptocurrencies, in this case to Bitcoin? Yes, we can, but the conclusion is that this fair value is devoid of any practical meaning because of the exceedingly high volatility of the cryptocurrency. So, and to put this concept across to you, let me please introduce the notion of gold risk equivalency. Let's suppose that one day Bitcoin replaces gold. Hence, we can think that the market cap of Bitcoin will be the same as that of gold. Since nowadays the market cap of gold is 4 times that of Bitcoin, we just multiply today's Bitcoin price by 4 to get to the long-term fair value of Bitcoin. But if we do this, we must also take into account the risk. So if we take into account the ratio of the market caps, we must take into account the ratio of the volatilities. So we multiply by 4, divide by 6, and we come to a fair value of Bitcoin, which is between 23,000 and 24,000, which is really far removed from today's Bitcoin value and even further removed from yesterday's value. So the conclusion is that once more, volatility must subside for us to be able to come up with a fair value for cryptocurrencies. Last but not least, I would like to spend a couple of words on the legal challenges lying ahead for cryptocurrencies. We don't know which one of them will be survive and universally adopted in our society, but we don't even know in which form these cryptocurrencies will survive, simply because of the regulatory interventions which are expected and are forthcoming. Think on top of this about the fact that shortly, well, in a not too far distant future, central banks are going to issue digital currencies, the so-called CBDCs. We don't know yet what kind of challenges these central bank digital currencies are going to pose for today's cryptocurrencies. So this is at the end of my presentation. I hope you've learned something useful in terms of the social utility of cryptocurrencies and of their highly speculative nature. Thank you for your attention.
Thank you to Giorgio for that cryptocurrency kung fu. And thank you to all our experts from the Emirates MBD CIO team. Anita, Satya, and of course, the effervescent Maurice. And thank you to you, the audience, for tuning in. Brilliant insights, I'm sure you agree. Now stay with us, because in a moment we'll cross to the live Q&A. The team are just finishing off their final stretching and warming up, and they're getting ready for it. You do still have time to get a question in, but be fast, because we've had a flood of queries come in already. But for now, thank you, and we'll be back in a moment, live and kicking. Welcome back. Now, here we join you at the live Q&A. And this is the point in the proceedings where we discover if I've drank enough coffee to keep up with Maurice. Now, I'm going to take this opportunity to say congratulations to Giorgio on his team's fine win in the European Championships. I'm not bitter at all, and therefore I promise Giorgio that I won't be sending all the hardest questions over your way. I will be sending all the hardest questions his way. We've got plenty of questions in from the audience, and the first one in is a big one. What are the implications of falling US Treasury yields? Maurice, over to you.
Oh, it's for me. I thought it's a fixed income question. Could have been Satya. So I will start on the big picture. You will carry on the Treasury yields themselves. Yes. Well, it's a broad question because there are many implications to falling interest rates, and for the economy it's not bad. It means that borrowing money is cheap, and if borrowing money is cheap, you know, it helps the economy. It also means that solvency is good, and just for that, keeping the US government afloat with the tremendous amounts of debt that we have now is not a bad thing. Now, if we reverse the view from a wealth management perspective, it means that you won't get return out of this very low risk instruments. It means that the risk-free return is not there anymore, and it is really the barometer for all the rest. So if you don't have yields on fixed income, the value, the multiple you can apply to the earnings in equity, typically the dividends, is higher. So this is what pushes everyone into higher valuations. And frankly, for the long term, it's a concern because it means that expected returns will be lower and you won't have return without risk. Now, Satya, maybe more on precisely the yield as well.
Exactly, Maurice. You say, I mean, whenever 10-year Treasury yields actually go below 1.4%, markets tends to get nervous. That's because 10-year treasury will actually go down when there is a negative sentiment on the growth of the economy. So if yields actually go below 1.2%, our current positioning that we are neutral high yield overweight emerging market debt and underweight developed market sovereign government bonds and IG credit, they will perform very poorly. That's a very different scenario, to be honest, because spreads tend to blow out at those levels. For example, last year just after the pandemic crash, the 10-year treasury yield was at 0.5%. Okay. So if treasury yields go below 1.1%, probably we'll have to relook our current positioning and view.
Thank you, Satya. Right, next question I think coming in from the audience. Again, you've still got time to post questions, so keep them coming in because we've had a really good response so far. But the next question coming in is, one for Anita. Okay, so going forward, Anita, where should one focus? Large cap, mid cap, or small cap?
So when we look at the large cap companies, and these are basically international companies where in the case of the US, you've got about 40 to 60% of revenue coming from overseas. In the case of technology, 60%. In the case of consumer, 40 to 50%. So if you are investing in large cap, you are investing in more international companies. When you are investing in mid cap or small cap, first of all, you also get the advantage of investing in niche themes, and you are exposed to the domestic economy. So they are more cyclical in nature. When you have economic growth being revised upwards, it's good to have a mix. Also, large cap means you can buy the equities individually. Mid cap and small cap, I would honestly say, focus on funds, focus on good manager.
Oh, a big one. Global regulators pushing for electrification of vehicles with fast growth in the sector. It's actually a really good question for this audience. The GCC is mainly oil dependent. How will this decrease demand for the oil impact the GCC economies in the medium to long term? Great question from the audience. Thank you for posting that one. Who'd like to field this one?
I can talk about the GCC economies, and Anita, you speak about electric vehicles, I'm sure.
Great.
Yeah?
Thanks.
So, oil demand, of course, in 100 years it will be very different, but our stance is clearly that oil is there to stay. Electric vehicles, the usages of energy will change with more sustainability, and it's a very good thing, but it's going to be very gradual. We don't think that the rise of electric vehicle currently, yes, it lowers the need for oil, but it's not a threat to GCC economies. We're talking about, global demand is 100 million barrels per day. Electric vehicles are substituting, but we have maybe 10 years for transition. Anita, you know better. And anyway, the time at which it will become material and GCC economy is far apart. And don't forget, many people say from an ESG perspective or whatever, oil is bad, but oil net is much more positive for the human society than it is bad for the environment. So we shouldn't say that it's just bad. It's a transition which is needed.
Interesting. And Anita, you're a massive fan of technology.
Yeah, okay. So electric vehicles is one of our top themes in terms of the transition that's happening. And I have to say that, in the UAE, in the KSA, all the money that is coming into the sovereign wealth funds from oil, they are using that to diversify. So I spoke about this earlier. In the UAE itself, in Dubai, you've got 300 electric charging stations. So even the oil-driven economies, KSA and the UAE are very much, following this transition. They are also highly digital economies, especially the UAE in terms of, the amount of, ramification in terms of internet use, in terms of digitization. So again, I think it's, a plus. The transition is gradual, as Maurice said, and there will be a diversification away from oil, but at the point right now that oil money is being well used in terms of, building up other assets.
Yeah, I mean, we've seen recently Dubai announce a whole bunch of regulations and new authorities for digital economy. So that digital and electrification, that's just a road that's going to continue, yes?
Yes, absolutely. Whether it is the development of the Mazda city in Abu Dhabi, or whether it is, the way the Expo 2020 is now, being built up, being developed, very definitely UAE is ahead. Even the airport, when you go through the airport, we know that.
Great. Another question coming in from the audience, this one for Maurice, and it's actually kind of connected to this topic here. We're talking about ESG now. We can't escape ESG right now. It is the topic that's driving many agendas in many corporations. And the question from the audience, Maurice, which is a good one, is you mentioned that Emirates NBD is developing your own ratings for bonds and funds. Why are you doing this? Is there not data vendors who are already doing this?
Oh, yes, of course, of course. Well, there is a short answer, but you know me, I will take the long one.
Absolutely.
The short answer is yes, there are data providers, and of course we use them. We use them to form our opinion on the instruments that we recommend. But our stance was to say we use, just to name a few, Sustainalytics, MSCI ESG ratings. We use the Barclays, Bloomberg, and the index composition, the UNPRI signatories. We use all of that, but at the end, we think that you have to have to own your own methodology. Typically for stocks, you can find lots of information on everything. For bonds, it's more difficult. For funds, almost nothing. You can just trust the people. So we have built a methodology that allows us to use all this data and at the end of the day to come with very simple 3 classification to say where is this product on the scale of sustainability. I prefer to say sustainability rather than ESG because we do wealth management and a big part of what we do is transgenerational. It's a long word for a French, but it's not just about your money in 10 years. It's also the world in 10 years and the money you will leave to your children. So it makes sense.
And that feels like that's getting increasingly more important. We seem to have stakeholders inside companies, stakeholders outside of company, social media. So ESG and sustainability in particular, that seems like an issue that is literally going to just keep growing louder and louder in the world.
Definitely, and to tell you everything, to be very transparent, we are late in the formalization of our process. We are doing it now, but we are not late in taking into account sustainability in investment. If you take the list of recommended stocks by Anita, for example, for years we run ESG screening on them. They are ranking very well. Why? Because we select businesses which have high quality attributes, which means that their product doesn't harm already the environment, the stakeholders, doesn't borrow from the future returns, and so we are formalizing, but no doubt it is the way forward. Yeah.
Right, now it's Giorgio's time. I know we have a difficult question for you. Back to crypto, the topic that we all love to talk about. Great question from the audience member as well. Thank you for submitting that. You say that crypto is both too risky and too expensive to be in your allocation now. The audience member is asking, does this mean you would reconsider one day, perhaps if they crash again or any other catalyst? And I can say about Elon Musk tweeting and sending the price crashing down again.
No, Elon Musk is no trigger for us. The level of price is no trigger for us. After all asset classes take turns at being cheap or expensive. Okay. And as I mentioned in the presentation, cryptocurrencies are cyclical macro assets simply because their yearly returns tend to follow the cycle. So what we mean when we say that rather for now avoid cryptocurrencies is that they are really, really too volatile. We must bear in mind that returns are the volatility is the uncertainty around our returns. So the higher the volatility, the less we know about the direction the cryptocurrencies are taking tomorrow. So if the volatility becomes too high, we know that retail investors mostly will be driving returns rather than institutional investors. So we need volatility to subside. We need broader acceptance of the cryptocurrencies in our society. We need more institutional money participation so that ourselves will be able to ascribe a fair value to these cryptocurrencies.
Yeah. I mean, it's interesting, Maurice, we've talked about this before as well. I mean, you've said in the past that, blockchain as a technology is here to stay, but perhaps cryptocurrency is something that's worth to take a step back at and take Giorgio's mature look at it.
Yeah, and
I'm not calling you old, by the way, when I say mature.
Frankly, we are not anti-crypto asset. It's not at all the point. Blockchain is a fabulous technology. It's a game changer. Yeah. The thing is that if we are in a world of professional investment advice, you have to have a fundamental framework to put a value and to make an advice. And currently, we are a bit in the noise, but don't get us wrong. We believe in the blockchain and we believe in its numerous applications, including for investment. It's just, we don't have enough clarity. It's too volatile, too correlated. It doesn't bring something to a portfolio, and we cannot do a professional advice. We will one day.
Thanks. Anita, back to you. And another great question from the audience I can see. The US market continues to move up. Is it time to book profits and exit, get out? Is it overvalued? That's a good question, that.
Okay, thanks for that, Scott. And before I start, let me just say I'm a huge fan of Elon Musk. Okay, so anything...
You're a huge fan of technology.
Yes, well, okay.
I can see you itching to weigh in on that.
Oh my God, yes, absolutely. And so on the US market, now that is the most innovative market today. They spend the most on research and development, whether it's healthcare, technology. Is also the companies there are the most digitized. Now, when we are looking at the single most important determinant of returns, and that is earnings growth. And for the US, you had a Q1 with a 52%, earnings growth, a Q2 expectation of 62%. The whole year, you're expecting 37% earnings growth. So I don't think that the market is overvalued. I think we're going to continue seeing that earnings growth supporting valuations. And the US also gives you a very broad platform in terms of the sectors to choose from.
It reminds me of something that we were at the live forum and people keep using the phrase time in the market versus timing in the market. Are you a fan of time in the market?
Yes, absolutely. So we say that if you stay invested is when you get the returns. So if you look at the last decade, you've got returns, on a compounded basis, 10% every year from the US. That's a 15% absolute return. If you had, exited every time you think there's going to be a crash, you cannot make those returns. So don't time the market, stay invested, but invest systematically across a period. That's what our advice always is.
Great advice, I like that. Satya, the Hulk, time for you to smash. A good question as well. With such current low rates, what's your viewpoint on increasing yields? Does it make sense for investors to allocate to fixed income?
Great question, actually, especially given the background.
Yeah.
The answer is short, one word: diversification. I know it's a cliche, but Maurice had talked about our 3 pillars for wealth management. One is backdrop, and that's very, very fluid. It can change in a day, it can change in a second. We don't know where the source of next volatility will be. Will it be the announcement of Fed taper timelines? Will it be a possibility of the next US debt selling crisis, or an increase in the geopolitical tension between US and China, right? So if you miss an asset class, there is a chance that you will miss the growth that comes out with it. I'll give you a small example. If you chase yields in Asia high yield, you will be really happy till May end. But in June and July, 2/3 of your returns would have been taken out. At the same time, if you are positioning in, for example, US-China IG, that gave 3-month, 3% kind of returns. So that actually shows that if you are invested, you are diversified, there will be source of growth within the asset classes that you can always enjoy. Otherwise, the concentration risk increases in the portfolio, which is never good for wealth management.
Good advice. Thank you, Satya. And now, Maurice, I think we're going to wrap this up with a final question for you. I think we'll end where we came in. How can I follow your allocation and get the same performance from my account? Not my account. This is from the audience member.
What a nice question too, and I could have written it myself because I have a fabulous answer. Is that
that's lucky.
Yes. We have just launched a little less than a year ago our very own fund of funds, proudly run from Dubai. They are not run by someone else in London who will not be accountable. People here will be accountable, where we implement exactly the asset allocation we discussed for the cautious, moderate, and aggressive, and we populate the portfolio with the very funds that we recommend on our open architecture platform. Open architecture means that we don't run ourselves Japanese equities or US bonds. We select the best manager in the world. We have a team for that. And then we assemble this, and it delivers the return that we show you. But it's quite new. It used to be on paper. Now it exists in form of funds. But I'm not even sure that I'm allowed to talk about products on an internet forum. So.
Nice exclusive there. I mean, is that you basically walking the walk as well as talking the talk? It must feel good to kind of bring this in-house and use your own expertise to do this.
Yeah, sure. You know,
I'm a massive fan of developing your own technology.
No, but walking the talk. Wealth management is about trust, and we are not UBS, we are not I don't know, HSBC, Goldman Sachs. We don't have 200 years of history or whatever, so that people say I have to trust these people. We have to be very accountable. You may have noticed that we always show our performances. We always say this is what we said, this is what happens. We've been right or wrong, and this is how you build the trust. And the next step was, of course, to run the money in these funds, to have a track record.
Yeah.
When we do well, we'll be super happy. We'll do like, oh, we are modest. When we'll do badly, we'll be there and we'll explain why as well.
Well, I suppose in this polarized world as well, it's important to earn trust rather than expect trust. What a good note to end. So from the Emirates MBD CIO team, I want to thank you all for tuning in. And there has been many of you, and thank you all for the questions. Again, one final thanks to Satya, to Maurice, to Anita, to Georgia. Well done, Italy. And thank you again to everybody that's joined us for this presentation today. Have a great day, and goodbye from us at the Arabian Business.